Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video trading recap of the trades that we made here today on January 7th. Now, as always with these trading alert videos that we do, we go over all the trades that we made for our members at OptionAlpha.com, and then we post this video about 5 to 7 days after it's available for just for members. So again, if you're watching this video on YouTube or publicly anyplace else, just understand that you can't take advantage of these trades because this alert video is posted about 5 to 7 days after it's available for our members. So today, unlike yesterday, Monday, where we had just a couple closing trades and no opening trades, it seems we've kind of gotten all those orders that I've had working in the system for a little while to actually fill. And now we have a couple trades that we can go over here tonight in the video. So I want to start by going over the 2 vertical call spreads that we made, and then I'll talk about the 3 vertical put spreads that we traded as well. Now, generally speaking, we have fairly low volatility in the overall market. So the fact that we had a couple vertical call spreads that we were able to enter is really, really nice opportunity in this kind of overall low volatility market. So let's go over those, and let's start with the first one, which is JCP, and that's JCPenney. And again, for those of you who are new, I know there's a lot of new people from the new 7-day pass that we published last night. There's almost 200 new members just in a couple hours last night. So a lot of new people here. And so what I want to do is go over just, again, recap the trading alerts that you get via text message. But in this case, we sold 4 vertical spreads. And so the -4 means that we're short 4 verticals or complete verticals, not just one or the other. And that what that means is with JCP is that we had sold the 9 calls, the 9 strike calls. We then bought the 10 strike calls to help finance the sale of the 9s. And the overall credit of each individual spread was 28 cents. So in this case, we collected a premium of 28 cents or $28 per vertical, and then we sold 4 of those types of strategies. So that's what we did on JCP. Now, the reason that we did that, I'm going to go to the chart of JCPenney so you can see that, is 2 things. One, because implied volatility was really at the upper end of its range. Okay, so you can barely see it here because it's in yellow, and that's just the way my indicator is. But implied volatility was above the 55th percentile today. It's come back down a little bit. That's because we already have a little bit of profit built in this trade at the end of the day. But because it was above that 55th percentile, and what that means is that implied volatility generally is below that area, then we felt good making a trade that was taking advantage of selling option premium. So we wouldn't buy a vertical spread in this case. And again, we'll show you an example of where we did today. But in this case, implied volatility was very, very high on JCPenney. So we had an opportunity to sell a call spread in JCPenney, the 910, and take advantage of that potential move lower in volatility. Now, we decided to go on the call side only because JCPenney has been fairly weak over the last couple of months, right? So statistically, what we could do is say, you know what, there's probably a good likelihood we could bounce at this point, but just generally how JCPenney has been trading over the last couple of months, I mean, obviously this huge move down that it had in September, we know that it's going to have a very, very tough time rallying. So we decided to go with the 9-10 call spread that puts our strikes here and about here. And statistically, it's a 70% chance of success trade. And I'll go to the actual chart of JCPenney, trade tab of JCPenney as well. Now you can see in the bottom left-hand corner, we always have our position up here so you guys understand. These are real trades that we're making. It's not fake trades, etc. Have a nice little profit already here for a little bit of the day that we had this trade on. But you'll notice that where our strikes are, the probability of JCPenney trading above that 9 strike, which is right here, is about 31%. And we took in a little bit of a premium, so it puts our break-even price just above $9 as a strike price. So we're trading about the 30% probability of in the money. And what that means is that there's a 30% chance that JCPenney trades and closes above $9 by expiration. So if you flip that around, since we're an option seller in this case, that means that what we're looking at is about a 70% chance of success on this trade. And that's usually where we want to be on these types of credit spreads. So that's the JCPenney trade that we made today. Let's go on to the vertical put spread that we sold on P, which is Pandora. Now, again, we talked about this in the last trading alert yesterday, that we had this order in and we were kind of waiting for some orders to fill on Pandora. But in this case, we sold the 30 puts, bought the 29 puts to help finance the sale of the 30s, and the overall credit between the two was 30 cents per spread. Now, again, we sold 4 complete spreads, So we're short for the 30, long 4 of the 29s, and altogether we had 4 times 30 or $100, $120 in credit that we took in on the total trade. But again, let's go over that right now so you guys understand why we took the put side of the trade for Pandora. So I'll go to the actual chart of Pandora here, and you'll see that Pandora's had a huge move up. And so what we decided to do in this case is take advantage of, again, one, high implied volatility. Again, it's a little bit yellow, but it's at the 52nd percentile, so it means it's above the halfway point historically. Historically, it should come back down at some point. But we decided to take the put side of the trade because Pandora continues to outperform the market. It just continues to make higher highs and higher lows consistently. So what we decided to do is, unlike a lot of the other ones, where we would usually take the other side of the trade, meaning that we would sell a call spread up above the market, we're actually going to take the put side of the trade here and potentially, hopefully, see Pandora continue to run up and move in the direction of the gap. Now, we also took this position on the put side, being a little bit bullish, because we have a lot of positions, including the ones that we entered today, that are really bearish on the market. So in an effort to help kind of balance out the portfolio, balance out our deltas, we decided to take the put side of the trade instead of the call side. Now, again, it doesn't matter which side of the trade you take, right? We take a look at Pandora, and again, down the bottom left-hand corner, always our trade is showing down here, the position, live trades, as always. But in this case, we took the put side of the trade only because of that delta risk that we talked about. We had too much negative delta in the portfolio, so we're trying to even it out. Now you can see here that the probability of being in the money, out of the money is right around 35, 34%. So again, about a good 65, 70% trade success. If we wanted to take the call side of the trade, we would actually go up here to around the 35, 36 strike. So again, you could take either side of this market. It doesn't matter as long as you trade the right strategy, meaning volatility, selling premium versus buying premium with high implied volatility. You can pick either side of the market. It just depends on what your portfolio is. So a lot of people have trouble saying, okay, which side of the market do we pick? And it really doesn't matter which side of the market so long as you're picking the right strategy and picking the right probability of success. So in either case, you could sell the 35-36 call spread, or you could sell the 30-29 put spread like we did. Either way, you're still trading about the same probability on each end. All right, so those are the two vertical credit spreads that we had. Those last ones here I'll go over fairly quickly because they're all about the same breed here, but we bought some vertical put spreads on XLF, BAC, and BBRY. And on the XLF trade, we bought the 23-21 puts, and that's a $2 wide strike. So we paid $1.04, so almost about halfway. The reason that we did that is because it's a low volatility trade. It's more of a directional trade than anything else. We're not trying to sell time decay. We're not trying to sell volatility or anything like that. It's more of a directional trade on just XLF. And because of that, we want to make it more of a 50-50 bet. So we usually like to target a 50% of the width of the strikes. So the width of the strikes in this case is 2, and we targeted a debit of around 1. Same thing here with BAC, Bank of America. Width of the strikes here is 18 and 15, so that's 3, and we targeted a middle price of 150, which is exactly what we got. That was a great entry. Again, we bought the 18s, sold the 15s. We paid $1.50 debit per spread, and we bought 3 of these spreads. So just so you know how those trading alerts work out. And then the last one, and we're going to kind of go over the charts for XLF, BAC, and BBRY, is that we bought the vertical put spread, the 9-8. So we bought the 9 puts, sold the 8s to help finance the purchase of the 9s, and we paid 52, or right above that 50% of the width of the strikes that we usually target. So again, the whole idea with these trades is that, again, we're not selling any type of premium. We're not trying to take advantage of implied volatility. Implied volatility on all of these trades is very, very low. You can see up in the top left-hand corner that implied volatility on Bank of America right now is in the 33rd percentile. So what that means is that almost 70% of the time implied volatility is higher than where it is now. So we wouldn't want to be selling implied volatility or selling credit spreads, strangles, iron condors, butterflies, anything like that. We're just taking more of a low volatility directional trade in the market. And so the only reason that we decided on the put side was because of, look, the chart clearly shows that Bank of America's had a huge run up. Today was very much a not good day for Bank of America. Had a lot of selling after the open, so it closed much, much lower than the actual open here today. And so we think at some point between now and expiration, it's going to close lower than where it's at now, or at least trade lower than where it's at right now. and we'll have an opportunity to take some money off the table. For BBRY, which is BlackBerry, again, same thing as Bank of America, super low implied volatility. It's at the 40th percentile, so very low for our standards of selling premium. And again, huge run up in BBRY recently, so we think at some point it's going to have a little bit of a correction here, and that's all we're looking for. It's just a little bit of a correction, an opportunity to take money off the table. It's more of a directional trade in the market. I forgot the other one that we traded, and this is literally how it goes. XLF, that's the one. So XLF, again, same thing here, really low implied volatility, 31 percentile, 70% of the time it's higher than where it is now. So we don't want to be option sellers now. We want to be basically buyers of options, and we take more of a directional bet. Same thing here, nice little run up here in the last month or so trading. So we think at some point we might have a dip down in XLF. And that's all we're betting on, is that between now and February expiration, it trades sometime, somewhere, somehow below where it's trading right now. Not that it closes there, not that we think it's going to be significantly higher or lower, but that it just trades below where it's at right now, because we have a 50-50 bet on, and at some point we're going to have an opportunity to take some money off the table. So again, hopefully you guys enjoy these video trading alerts. For those of you who are new, please add your comments right below this video in the comment section here on the membership platform. I'll get to each and every one of those tonight, and happy trading.